Most investors believe that the hardest part of investing is knowing when to buy. Professional investors know that this belief is wrong. The real difference between long-term financial success and repeated disappointment is not entry timing, it is exit discipline. History shows that many investors correctly identify winning assets, strong trends, and profitable opportunities. Yet they still lose money, not because they were wrong, but because they stayed too long, exited too late, or ignored clear warning signals. Professional investors approach exits very differently. They do not rely on hope, emotion, or headlines. They rely on structured decision frameworks, risk management rules, and forward-looking indicators that tell them when a winning trade has reached its optimal point. In this report, we will break down exactly how professional investors decide when to exit winning trades, why this process protects capital, and how poor exit decisions quietly destroy long-term wealth. Introduction: Why exit strategy matters more than entry. In financial markets, profit is never real until it is realized. An unrealized gain is not wealth, it is exposure. Professional investors understand that markets move in cycles. Every trend eventually slows. Every rally eventually matures. Every asset eventually faces resistance from valuation, liquidity, or economic reality. Retail investors often stay invested because prices are rising. Professionals become more cautious for the same reason. The goal of professional investing is not to capture the absolute top. The goal is to exit while risk is still manageable and capital preservation is intact. Exiting a winning trade is a strategic decision, not an emotional one. The core principle: capital preservation comes first. Professional investors operate under a single, unbreakable rule: protect capital first, grow capital second. This mindset changes everything. A winning trade is treated as capital at risk, not a trophy to admire. The larger the gain, the more carefully it is protected. Professionals ask different questions than most investors. How much downside risk exists from current levels? Has the risk-to-reward ratio deteriorated? Are macroeconomic conditions changing? Is liquidity improving or tightening? Are valuations expanding beyond fundamentals? If the answers suggest rising risk, professionals begin planning exits, even if prices continue to rise. Valuation signals: when price outruns fundamentals. Valuation does not tell investors when prices will fall. It tells them when risk is increasing. Professional investors track price-to-earnings ratios, price-to-sales ratios, market capitalization relative to economic output, historical valuation ranges. When prices move far above historical norms without corresponding earnings growth, professionals recognize that future returns are being pulled forward. At this stage, upside potential shrinks while downside risk grows. This is often when professionals begin trimming positions rather than exiting all at once. Liquidity conditions: the hidden driver of market moves. Liquidity is the fuel of financial markets. When liquidity is abundant, markets rise easily. When liquidity tightens, markets become fragile. Professional investors monitor central bank balance sheets, interest rate policy direction, credit availability, treasury issuance levels. When liquidity conditions begin to tighten, professionals understand that risk assets face headwinds even if prices remain elevated. This is often when professionals reduce exposure gradually, rather than waiting for visible market stress. Retail investors usually notice liquidity tightening only after markets begin falling. Professionals act before that point. Technical structure: identifying trend exhaustion. Technical analysis is not used by professionals to predict the future. It is used to identify risk. Key signals include breakdown of long-term trend lines, failure to make higher highs, increasing volatility near market tops, divergence between price and momentum indicators. When a winning trade begins showing structural weakness, professionals prepare exit strategies. Importantly, professionals do not wait for confirmation from headlines. They trust the data. Position sizing and scaling out strategies. Professional investors rarely exit a winning trade in a single decision. They scale out. This approach reduces emotional pressure and improves average exit prices. Common methods include selling a portion at predefined profit levels, reducing exposure when risk metrics rise, locking in gains as volatility increases. Scaling out allows professionals to remain partially invested while protecting the majority of gains. Retail investors often hold full positions until fear forces them to sell. Professionals reduce risk gradually while conditions are still favorable. Macroeconomic shifts and regime changes. Professional investors pay close attention to macroeconomic regime changes. These include transitions from expansion to slowdown, shifts from low inflation to high inflation, changes in labor market strength, rising debt servicing costs. When macro conditions shift, asset behavior changes. An asset that performs well in one regime may underperform in another. Professionals exit winning trades not because the asset failed, but because the environment supporting it is changing. Risk to reward deterioration. Every trade begins with a favorable risk to reward ratio. Over time, that ratio changes. As prices rise, potential upside decreases. Potential downside increases. Volatility expands. Professionals exit when risk to reward no longer justifies staying invested. This is one of the most important concepts in professional investing, yet one of the least understood by retail participants. Psychology: why emotion destroys exit discipline. Emotion is the enemy of exit decisions. Greed convinces investors that gains will continue indefinitely. Fear prevents them from locking in profits. Professional investors remove emotion through rules. They predefine exit levels, risk thresholds, maximum exposure limits. By following systems instead of feelings, professionals maintain consistency across market cycles. Case study patterns: what history teaches us. Market history repeatedly shows the same pattern. Strong trend, widespread optimism, valuation expansion, liquidity tightening, volatility increase, rapid reversal. Professional investors study these patterns not to predict timing, but to recognize warning signs. Exits are planned during strength, not during panic. Real-life impact on American investors. For American households, poor exit decisions have real consequences. They affect retirement account stability, home purchase timing, college savings, small business liquidity. Holding winning assets too long can erase years of gains in months. Professional exit discipline protects financial progress. What may happen next in current markets? Current U.S. markets face elevated valuations, persistent inflation pressures, higher interest rate sensitivity, increased fiscal borrowing. These conditions increase the importance of disciplined exits. Professionals are not abandoning markets. They are adjusting exposure, tightening risk controls, and preparing for volatility. The real skill of investing is not finding winners. It is knowing when a winner has done its job. Professional investors succeed because they understand that markets reward discipline, not emotion. They exit with intention, protect capital, and prepare for the next opportunity. In finance, survival is success, and disciplined exits are what make survival possible.